Banking is presented as a system built on trust and stability. It promises convenience, security, and financial control. So why do small, everyday financial mistakes quietly generate billions of dollars in profit? Most people see banks as neutral service providers. They hold deposits, they process payments, they issue loans. Fees are understood as consequences, not strategies. If someone overdrafts, a charge seems fair. If a payment is late, a penalty appears justified. If a balance is carried, interest feels expected. This interpretation feels logical. Rules are disclosed. Due dates are listed. Balances are visible in apps. The system appears transparent. Responsibility appears personal. Financial culture reinforces this belief. Banking apps send alerts. Statements show transaction histories. Credit agreements outline terms in advance. The message is consistent. The tools are available. The rules are clear. Mistakes are individual. Within this narrative, banks respond to behavior. They do not shape it. Small fees are framed as discipline. Interest is framed as the price of access. Nothing appears hidden. Because nearly everyone uses these systems, the structure feels ordinary. Opening an account is routine. Using a card is routine. Paying monthly bills is routine. Fees become part of adulthood. Unpleasant, but normal. In practice, small financial mistakes are not rare. They are predictable. Across millions of accounts, behavior follows patterns. Income arrives on specific dates. Bills withdraw automatically. Subscriptions renew quietly. Transactions process at different speeds. Timing gaps are common. A payment clears before a deposit settles. A due date is misread. A small balance is underestimated. Each event appears minor, but systems operate at scale. If a fraction of customers overdraft each month, that fraction becomes measurable revenue. If a percentage of credit card users carry balances, interest becomes consistent income. Banks operate on probability, not exceptions. They know how often overdrafts occur. They know how frequently late payments happen. They know what share of customers revolve balances. These behaviors are modeled in advance. Revenue forecasts include them. Overdraft fees illustrate this clearly. A single fee may cost $30. For one person, it feels frustrating. For a bank with millions of accounts, recurring overdrafts become a steady income stream. Credit cards follow a similar structure. A missed payment triggers a fee. A carried balance triggers interest. Higher rates may apply after repeated lateness. The system does not require financial collapse. It requires small inconsistencies. Human behavior is variable. Cash flow fluctuates. Attention shifts. Banking infrastructure, however, is exact. Deadlines are automated. Processing times are rigid. Interest accrues without pause. The interaction between flexible human timing and fixed digital systems creates friction. That friction produces charges. This does not require malicious intent. It reflects incentive alignment. If a portion of profit depends on overdrafts and interest, eliminating those behaviors entirely would reduce revenue. So the system is optimized for management, not prevention. Warnings exist, alerts exist, but deadlines remain fixed. Fees activate automatically. The structure does not prevent small mistakes. It monetizes them. Most financial mistakes feel temporary. An overdraft seems like a one-time error. A late payment feels accidental. A small balance appears manageable. Because each event feels isolated, it rarely triggers deeper reflection. Instead, it creates mild stress. The fee is paid. The balance is adjusted. Attention shifts elsewhere. Modern financial life increases complexity. Multiple accounts, automatic withdrawals, variable income, constant notifications. Cognitive load grows. Under stress, precision declines. People estimate rather than calculate. They assume deposits will clear sooner. They overlook small recurring charges. The system, however, operates with precision. Cutoff times matter. posting order matters. Payment timestamps matter. Human approximation meets digital exactness. The gap produces recurring friction. There is also normalization. If a fee happens once, it feels frustrating. If it happens periodically, it becomes expected. Language softens impact. Overdraft protection. Minimum payment. Service fee. The terms frame penalties as standard features. Over time, small charges blend into monthly statements. They are noticed briefly, then absorbed. No single mistake feels decisive, but repetition creates pattern. And when small misalignments occur across millions of accounts, the revenue becomes reliable. Not dramatic, not explosive, quiet, predictable, continuous. Small financial mistakes persist because they generate predictable returns. Banks benefit first. Overdraft fees, late payment penalties, and revolving interest create revenue that does not depend on new customers. It depends on ongoing activity. A customer who occasionally overdrafts may generate more fee income than one who never does. A credit card user who carries a balance becomes more profitable than one who pays in full. The system does not require widespread default. It requires continuation. Interest accrues over time. Fees apply instantly. Penalty rates may increase after repeated lateness. These mechanisms are built into contracts. They are legal. They are disclosed. They are automated. Revenue emerges from repetition. Payment networks also benefit. Every transaction generates processing fees. Higher usage increases transaction volume. More friction often leads to more transactions. Retailers benefit indirectly. Credit access allows purchases that might otherwise be delayed. Overdraft approval prevents declined transactions at checkout. Convenience preserves sales. Profit is not concentrated in one place. It flows through interconnected systems. Banks, payment processors, and lending platforms all depend on predictable consumer behavior. The structure does not need coordinated intent. It relies on aligned incentives. When small financial errors occur regularly across millions of users, they create stable financial outcomes for institutions. The predictability is the advantage. Consistency supports quarterly projections. Modeling supports pricing. Fees support other free features. Free checking accounts, rewards programs, and promotional offers are often subsidized by those who trigger penalties or carry interest. Small mistakes help fund visible benefits. The system balances itself through distribution. Some customers avoid fees entirely. Others incur them periodically. At scale, the averages matter more than individual outcomes. The system persists because it feels ordinary. Nearly everyone has experienced a late fee. Nearly everyone has paid interest at some point. Because the amounts are usually modest, they do not register as structural issues. A $30 overdraft does not feel systemic. It feels inconvenient. A month of credit card interest does not feel transformative. It feels temporary. Financial life is complex enough that occasional penalties appear unavoidable. Bills overlap. Income timing shifts. Unexpected expenses arise. The structure of modern finance is layered. Checking accounts connect to debit cards. Debit cards connect to automatic withdrawals. Credit cards connect to subscription services. Each layer introduces timing risk. Because these systems are digital and automated, their rigidity is invisible. Transactions clear instantly. Fees apply instantly. Interest calculates instantly. There is no negotiation phase. The automation gives the impression of efficiency. But efficiency for the system can mean inflexibility for the user. Over time, repeated small fees become background noise. They are factored into monthly expectations. The language surrounding them reinforces acceptance. Standard charges, service adjustments, terms and conditions. Nothing sounds extraordinary. Cultural messaging also reinforces the belief that careful management solves everything. Financial advice often emphasizes budgeting, tracking, and discipline. When a fee occurs, the instinct is self-correction. Rarely does attention shift towards structural design. Because the system functions for most transactions, its friction points are treated as minor side effects. The absence of dramatic failure makes the structure appear stable. There is no visible crisis, only steady extraction. Normalization removes urgency. When a pattern is common, it feels inevitable. And when it feels inevitable, questioning declines. Banks do not rely on catastrophic mistakes to generate profit. They rely on ordinary human behavior interacting with automated systems. Small timing gaps, small miscalculations, small lapses in attention. Each event feels personal. But across millions of accounts, these events form patterns. Patterns become projections. Projections become revenue. The system does not need secrecy. Its rules are disclosed. It does not require failure. It requires variability. Human behavior is flexible. Financial infrastructure is fixed. Where flexibility meets rigidity, friction appears. That friction has value. This does not mean individuals are careless. It means they are operating within a structure designed to monetize minor inconsistencies. Small financial mistakes are not dramatic enough to provoke outrage. They are frequent enough to generate stability, and that stability is profitable. The consistency of these outcomes does not reflect widespread irresponsibility. It reflects the alignment between predictable human behavior and automated financial design. When mistakes are ordinary and systems are precise, the result is not chaos. It is dependable revenue, quiet, sustained, normalized.